Welcome back. Right now, silver is sitting at $74.76, while gold is trading at $4,675.80. On the surface, it looks like a standard consolidation day, perhaps a slow news day where both metals are slightly in the red. But beneath the daily chart noise, a structural situation is building inside the futures market that is 4 days away from its most critical stress test. The outcome will either confirm that the current price suppression mechanism remains intact, or it will expose a supply reality moving toward a crisis. I'm going to walk you through exactly what is at stake and why July is not just another month. It is a convergence point. The number that matters most tonight is 135 million. That is the current open interest in the May silver contract on the exchange. This is derived from approximately 26,963 contracts, each one representing 5,000 troy ounces of silver. If every single one of those contract holders decided to stand for physical delivery, the exchange would owe 135 million ounces. However, sitting across from that massive obligation is a registered silver supply of just 77 million ounces. That is the total supply officially designated as available, not estimated, but registered, meaning it is vaulted, verified, and on the hook. 135 million ounces of claims versus 77 million ounces of supply. That gap is not a technicality, it is a fundamental breakdown. Thursday, April 30th, is first notice day for the May contract, the date when that gap either gets managed or becomes impossible to ignore. You need to understand what is at stake before Thursday arrives, because by Friday, the window for calm analysis will have already closed. To fully grasp the magnitude of the trajectory that makes this approaching Thursday deadline so monumental, we have to deeply look back at the historical context. In October of last year, the registered silver inventory at the primary exchange sat at approximately 157 million ounces. Tonight, exactly 6 months later, that figure stands at just 77 million. That is a massive 50% collapse in the available physical silver. It backed the largest silver futures exchange in the entire world, and it happened completely inside of half a year. But the drain does not stop. There is also what is called eligible silver, which is metal physically stored at approved vaults but not officially designated for immediate delivery. In theory, some of that eligible silver could be voluntarily converted to registered status, meaning it could technically become available to cover sudden delivery demand. But even that secondary buffer is rapidly disappearing before our eyes. The eligible silver inventory has dropped by over 100 million ounces recently. Both lines, registered and eligible, are trending down hard and continuously. The market is telling you something with unmistakable clarity. Production is simply not keeping pace with consumption. Withdrawals are far exceeding deposits, and the inventory available to back the paper obligations is being cut. The inventory is halved, while the obligations themselves remain absolutely enormous. The market is speaking loudly. The real question is whether you are listening. Are you listening before Thursday or after Thursday? April 30th is first notice day for the May silver contract. By Thursday, any contract holder who genuinely intends to take physical delivery must formally declare that intent. After that declaration, the clock truly begins. For the exchange to successfully navigate May without a complete structural failure, fewer than 15,000 contracts can ultimately stand for delivery. The arithmetic is exact and entirely unforgiving. 15,000 contracts multiplied by 5,000 ounces per contract equals exactly 75 million ounces. That is essentially every single registered ounce remaining in the vault right now. If precisely 15,000 contracts stand, the entire registered inventory is wiped out. Because the arithmetic is so uncompromising, the current open interest representing 135 million ounces must come down dramatically between now and Thursday. In previous delivery months, it did come down, but the critical detail is this, based on the exact pace of reduction observed lately. The open interest is simply not declining fast enough, relative to what the last 2 delivery cycles demanded. This brings us to a specific recurring pattern that deserves your absolute undivided attention tonight. In December of last year, in the exact days immediately preceding first notice day, the exchange servers conveniently went offline. The publicly stated reason was a routine technical issue, but the timing was surgically precise, landing on the Monday and Tuesday of that critical week, exactly when intense behind-the-scenes negotiation pressure would need to be applied to stubborn contract holders. The exchange deliberately used that dark, offline window to quietly persuade holders to roll their contracts forward, rather than demanding physical delivery, offering lucrative cash premiums and applying immense institutional pressure to prevent the registered vault from being drawn down below a survivable threshold. Then, in February of this year, the exact same thing happened. A mysterious server outage, the same timing, and the same quiet resolution. This is no longer a random anomaly, it is a well-established institutional playbook. We are talking about 2 consecutive delivery months. If the open interest heading into Wednesday is not declining at the aggressive pace required, The probability of a third stealth outage is incredibly high. It is not theoretical. It is precisely what the historical data predicts will happen next. The crucial question is not whether they survive May. The question is what physical metal genuinely remains in the vault after they do, and what that leaves for the upcoming July deliveries. If the exchange executes another stealth force majeure in May, another convenient server excuse, the price of silver does not crash. It gets managed sideways in the short term, but the registered inventory still takes a massive, undeniable hit. Whatever is left after May permanently determines the viability of the entire Western system. Let us project the most conservative scenario possible. If a mere 10,000 contracts stand for delivery in May, not the maximum 15,000, just 10,000, then 50 million ounces immediately leave registered inventory. That brings the total down to somewhere between 20 and 30 million ounces. At 20 to 30 million ounces of registered silver, the Western exchange is no longer credible as a global price-setting mechanism. You absolutely cannot set the worldwide silver price from a vault that holds significantly less physical metal than the exchange in China. That is not a hypothetical scenario constructed for dramatic effect on a podcast. That number, 36 million ounces, is currently sitting fully vaulted in Chinese exchanges right now. While Western vaults are systematically draining, the physical metal is moving decisively east. In March of this year, China imported 27 million ounces of silver in a single calendar month. That is the largest monthly import in their entire recorded history. As a direct result, the combined silver inventory across the Shanghai exchanges has skyrocketed. If the May delivery cycle in the West draws down 50 million ounces, the United States will hold significantly less than China. The core argument that America sets the global silver price does not just weaken, it becomes structurally and logically indefensible. That intense pressure point gets tightened even further by one more critical macroeconomic data point arriving in exactly 4 days. Starting on May 1st, China is officially restricting all exports of sulfuric acid. Sulfuric acid is not a peripheral material. It is a primary mandatory processing input for copper ore refining. Because approximately 1/4 of the world's annual silver supply is extracted as a byproduct of copper production, less sulfuric acid means less copper refining globally. Less copper processing mathematically guarantees less silver coming out of the ground. We are facing structurally restricted global silver supply, arriving at precisely the moment when exchange inventory is at a 6-year floor. This is not a random coincidence. This is a highly coordinated, extremely deliberate policy move executed by a global superpower. Now we must urgently pivot from physical supply to look at something extraordinary happening in the derivative markets, specifically in the gold options market. The mainstream financial press is entirely ignoring this. Right now, there are December gold call options sitting at massive strike prices. We are seeing strikes of $10,000, $15,000, and $20,000. Each contract represents 100 ounces of gold. The open interest at those three extreme strike prices is absolutely staggering. There are currently 8,400 contracts at the $10,000 level, 20,000 contracts at the $15,000 level, and 21,000 contracts specifically betting on the $20,000 level. The combined value of those speculative positions is approximately $30 million, and that massive number is growing rapidly. In the last trading session alone, the total open interest across those three specific strikes increased by over 1,000 contracts. Meanwhile, at the current actual trading price of around $4,700, the open interest barely reaches 3 meager digits. Let that dramatic comparison truly sink in. At the actual trading price, there is tiny interest, but there are tens of thousands of open contracts. These contracts are growing every single session, at prices 2 to 4 times higher. Volatility traders simply do not buy these kinds of positions. They use delta hedging strategies. They do not concentrate $30 million at strike prices that require the asset to quadruple from current levels. What this unique configuration represents is a massive directional bet on a singular monumental policy event. It is an institutional bet on a fundamental engineered revaluation of the asset to solve a systemic global debt crisis. The United States government currently carries the gold it acquired in the 1930s at a fractional $42.22 per ounce. The gap between that fictional book value and the modern market reality represents an enormous unrealized asset inside the Federal Reserve's balance sheet. If the U.S. were to revalue its gold holdings to $5,000 per ounce, the adjustment would generate trillions in treasury capacity. Those massive out-of-the-money options make absolute sense in exactly one scenario: a planned, imminent revaluation. This brings us perfectly to the impending policy convergence and the fast-approaching deadlines. On January 14th, the White House officially issued a formal trade proclamation directing the explicit consideration of price floors for critical minerals. Crucially, it requires a formal detailed update on the status of those exact negotiations within 180 days. 180 days from January 14th lands precisely on July 13th. That is not a soft suggestion. It is a binding presidential directive. It is aimed directly at critical commodities like silver, which has prominently been on the strategic critical minerals list for multiple years. When the world's largest economy issues a formal directive to aggressively implement price floors, while the primary exchange is draining its physical inventory at breakneck speed, those two specific facts are absolutely related. The United States currently carries a staggering $40 trillion in national debt at an average blended interest rate of approximately 4%. The resulting annual interest expense is roughly $1.3 trillion. The entire financial system is mathematically trapped. If that rate climbed to 12%, interest would catastrophically reach $5 trillion, consuming all federal tax receipts. The political apparatus will never allow a sovereign default, which means aggregate interest rates will inherently be managed lower. Managing rates lower while carrying $40 trillion of debt guarantees the fundamental purchasing power of the fiat dollar declines. A declining dollar dictates that hard, tangible assets must rapidly reprice upward just to maintain their real-world baseline value. Bank of America has a research forecast for silver ranging from $135 to $300 before the year ends. We are actively looking at a financial system deliberately engineered for a violent upward reset. The final, inescapable piece of this highly complex puzzle is the explosive, unrelenting industrial demand, which is fundamentally transforming the entire physical landscape. We are currently right in the middle of a massive, unprecedented global energy crisis. When baseline energy costs aggressively rise fast enough, global households and large industrial operators rapidly stop choosing their power sources based purely on price. They begin choosing strictly based on immediate, reliable availability. The transition to massive solar infrastructure, electric vehicle adoption, and battery-based storage systems permanently stops being a calm 10-year financial calculation. It immediately becomes a frantic, absolute necessity. The payback period on a residential rooftop solar installation violently collapses from a full decade down to just 3 or 4 years. The terrible alternative is a monthly electricity bill that has completely tripled. Silver is absolutely not optional in this massive green transition. It is an undeniable, rigid physical requirement. A single residential solar installation consumes approximately 20 grams of silver strictly in its high-efficiency photovoltaic cells. A massive utility-scale array requires staggering orders of magnitude more silver. The complex wiring and robust battery management systems across the electric vehicle supply chain all fiercely draw from the exact same finite supply pool. The supply is simultaneously being rapidly drained from the global exchange vaults. The buyer of a commercial or residential solar installation simply does not negotiate on the internal silver content. If those specific panels cost 30% more because the raw silver abruptly repriced significantly higher, that is perfectly fine with them. The terrible alternative is a tripled energy bill for the next entire decade. That specific buyer is entirely price insensitive. You possess immense price-insensitive demand crashing violently into a supply pool that is actively draining, severely restricted by foreign sovereign export controls. This incredibly tight window of opportunity is closing much faster than most casual observers realize. If you found this breakdown valuable, please hit the like button, subscribe to the channel, and ring the notification bell for market updates. Share this video with anyone who needs to understand the structural shifts happening right beneath our feet. Thank you for watching. Stay fiercely physical, stay deeply informed, and make sure you remain correctly positioned for what is rapidly approaching the global markets.